There we are. Good morning, everyone. It's 10 o'clock on Tuesday, and that means it's time for our weekly webinar. I hope everybody had a great weekend. It's good to see you all, as much as I can see you. Geez, it's almost the end of the summer. It's August 15th. My oldest son's birthday today, so happy birthday, Dan. I hope you're enjoying the summer and kids are going back to school and all that stuff, and at least the college kids, right? But it's all wrapping up for this year. All right, so we're going to, if you're just joining us on YouTube, please hit the subscribe, like, and notification button, and I'll break down the format of this full webinar. So first, we're going to talk about some updates we get from the Slott Group. So there's so many good ones. And I know I say this all the time, but there's so many good ones. And I pulled out what I thought were two interesting ones today. So we're going to go over some IRA distribution rule updates and two really good reports today from our analysts at the Slott Group. We're going to talk about the markets a bit. We're a little light on the analyst reports this week. They really weren't saying a lot. Nothing that I found interesting to share with you anyway. And then we're going to go into our Financial 15, which is the last 15 minutes or so of this broadcast, where we're going to talk about our financial planning topic. And today's financial planning topic is going to be part 4 of a series, the Get to Zero Tax and Retirement series. And part 4 today is going to be Social Security. So you may not know it, but your Social Security can be subject to tax, and we're going to learn how that works and how you might be able to avoid that. It is shocking to me when I talk to folks who are in their early to mid 50s and they're talking about retirement planning. There's just some things it's not on their radar. Taxation of Social Security is number one. Everybody knows about their Uncle Sam, but unless you're a really in-depth reader about retirement planning, you probably or already 65 or above, you probably don't know about your Aunt Irma income-related monthly adjustment amount, and that's the additional amount that you pay for Medicare benefits over certain thresholds. And we have a whole video on that. They also most people also aren't planning for the out-of-pocket costs of medical expenses when you start receiving Medicare benefits. So these are some things that are important to know as you're doing your retirement planning. And these are some of the issues we like to identify for folks and have the answers to them. This broadcast is indexed. So if you don't want to sit through my commentary about the markets or the Slott updates, and you're just here for the lesson about learning about taxation of Social Security, you can find it separately via Financial 15 video, and there's a playlist on our YouTube channel, but don't run away yet. You can just choose, go right to the chapter or the spot on here. It should be indexed in the description, and you'll be able, or just move the bar along, right? And you should be able to find that. Okay. We've talked a lot about our new website. We have an upcoming class coming. So the Change Your World of Retirement Planning class, that's kind of our flagship class. It's everybody really seems to enjoy this retirement training, and that's going to be via webinar. So the classes are going to start September 28th. So they run 2 consecutive Thursdays, 2 consecutive Tuesdays. So September 28th and October 5th and October 3rd and October 10th. You'll all get, I don't know about you all, but there'll be invitations sent out. I don't know where you're listening from. I'm always kind of surprised where folks are tuning in from, but you'll get an invitation. If you want an invitation and you don't receive one, you can reach us at questions@outofourwealth.com. That's questions@outofourwealth.com. Give it a couple weeks. We're not quite ready to send out the invitations yet, but we'll get them out to you. But if you want to get on the queue, feel free to reach out. That's fine. So that'll be the Change Your World of Retirement class. They run from 6:30 p.m. to 9:30 p.m. There'll be 2 consecutive Thursdays, 2 consecutive Tuesdays, starting on September 28th for Thursday and October 3rd for the Tuesday classes. So looking forward to seeing you all there. I'm always looking forward to meeting new people in that program. All right. I did share with you, I'll say it again because it's here in my headlines. I was nominated or received the 5-Star Wealth Manager Award for the Philadelphia area again for the 11th consecutive year. So I'll say that a few more times because I'm very proud of it. Let me share my screen here. So you should see our first letter from the Slott Group, and this is from our friend Sarah Branner. You know, I talk to Sarah all the time. She lives close by here, and I see her live a couple times a year, and we've had her on as guest. But this discusses the RMD relief that I've been talking to you about. So follow along with us. So I'm obviously starting. Where's my cursor? Starting right here. The IRS unleashed massive confusion last year. Boy, to say the least. To the surprise of many, it released proposed Secure Act regulations requiring beneficiaries on some occasions to take required minimum distributions during the 10-year payout period for inherited IRAs. To help with the confusion, the IRS issued some transitional relief. Last year, the IRS issued Notice 2022-53, which waived penalties for missed 2021 and 2022 RMDs within the 10-year period. Recently, the service released, that's the IRS, the service released Notice 2023-54, which extends the penalty waiver to cover missed 2023 RMDs when the death occurred in 2020 or 2021. It also excuses the penalty for missed 2023 RMDs within the 10-year period when the death took place in 2022. They're basically going back and saying, we know that we've been giving you conflicting information, and we don't want you to feel as though you have to take these required minimum distributions during this time of uncertainty that we're creating, the IRS says. It kind of makes it worse because people are just hearing about this forgiveness of RMDs and they thinking it applies to individual RMDs, and it's not necessarily so. There's only 1 year where that applies. So be careful. Sarah goes on to write, I'm here at first. Where's my cursor? At first. It may seem that every beneficiary who is subject to the 10-year rule and would otherwise be required to take an RMD for 2023 should take advantage of the opportunity to skip their 2023 RMD. It may seem like a no-brainer to keep the funds in the account if not needed and avoid an immediate tax bill. However, this may not actually be a smart planning move. Why? Well, anyone who is eligible for this relief also has the 10-year deadline looming. It may be tempting to skip an RMD for 2023, but that could mean more pain later when a potentially larger tax bill comes due at the end of the 10-year holding period. A better strategy may be to say no thank you to the IRS RMD relief, allowing you to take nothing, maybe for the third year in a row. Instead, take advantage of the waiver to do some flexible distribution planning. So it doesn't mean you have to take all of the, when you're talking about a required minimum distribution, typically the IRS says this is the minimum amount that you must take. Well, if you're one of those folks who have the waiver, you can take less than that now and still take a distribution. So Sarah talks about you might have a larger tax bill in the future, and she's really just talking about the compound growth. I haven't talked to her about this, but my feeling is she's just talking about the compound growth of that tax bill, but we all know that taxes are going to be higher in the future. So not only do we have that compound growth of that tax bill, but we also have the fact that taxes are going to increase. So that's going to make their tax bill larger. I'm having a lighting issue, so so here I am. I'm back here. Okay, so here's an example. So she talks about doing some planning around this, and it makes sense to, of course, look at this to see if you should take advantage of this waiver or not. So let's look at the example together. Here's the example. Deborah, age 75, died in 2020. The beneficiary of her traditional IRA is her adult daughter, Brittany. Brittany is a non-eligible designated beneficiary subject to the 10-year rule under the Secure Act. The proposed regulations say that because Deborah died after her required beginning date, Brittany must take RMDs based on Brittany's single life expectancy during years 1 through 9 of the 10-year period. Remember, since Deborah passed away after the required beginning date, and she had started already. Once you start, you can't stop. Start me up, don't stop. Remember, refer to the Rolling Stones song that Sarah So brilliantly used. So Brittany must take RMDs based on her single life expectancy during years 1 through 9 of the 10-year period. However, notice 2022-53 said that if Brittany failed to do so for 2021 and 2022, there is no penalty on the missed RMDs. Notice 2023-54 extends this relief to 2023 RMDs just for these tax years, folks. Again, IRS is going back and trying to correct this mess they've created. So going on, because Brittany is eligible for relief from the RMDs during the 10-year period for years 2021, 2022, and now 2023, she could take nothing in 2023 for a third year in a row. However, she may want to consider taking distributions anyway to minimize the tax hit in future years, despite notices 2022-53 and 2023-54, drawing down the inherited IRA throughout the 10-year period while being cognizant of current tax brackets could be a wise tax planning strategy. So great article, Sarah. All right, moving on. Our friend Andy Ives wrote an article called Anomalies and Exceptions. I really enjoyed this article, and I hope you do too. I'm a little bit of a IRA distribution geek here. I understand that, and tax planning geek, but I hope you enjoy it as well. So as already complicated IRA rules spiral further into an abyss of confusion, Andy writes, it comes as no surprise that irregularities exist. Up is down and left is right. Green means stop. Red means throw your hands up in exasperation. And those in charge recognize the lunacy. Case in point, many parts of the tax code are compromises, and all parts reflect the need for lines that can't be deduced from first principles. The code's lines are arbitrary. This is from a tax. So this is right from tax law, tax court update. We get these all the time in the Slott training sessions that we attend twice a year. But this is an example of one of the areas, one of the pieces of information we get. So that's a statement from Young Kim versus the Commissioner of the U.S. Court of Appeals, 7th Circuit. Blah, 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 May 9th, 2012. Here are 3 such random anomalies and exceptions baked into the arbitrary lines of the tax code. Excess contribution. Earnings can stay after the deadline. To contribute to any IRA, a person or her spouse, his or her spouse, must have earned income compensation. But too much income precludes one from contributing to a Roth IRA. Oftentimes, confusion over the rules or just plain negligence leads to an ineligible deposit. That's considered an excess contribution. But no worries, there are corrective steps in place to alleviate the problem. Yeah, we once had a client who did this for about 15 years before meeting us, and then we had to correct the problem. An excess contribution can be fixed with no penalty by October 15th, generally of the year after the year for which the contribution was made. If the fix is made prior to this deadline, the excess and any earnings, technically net income attributable or NIA, can be withdrawn penalty-free. The earnings will be taxable, but no special tax forms need to be filed. Well, here's the anomaly. In a strange twist, if the excess contribution is corrected after the October 15th deadline, the NIA does not need to be withdrawn. There is a 6% annual penalty on the excess, and that excess must be removed from the account, but any earnings can remain. This is true even if the IRA owner was totally ineligible to open the account in the first place. Roth conversion, inherited IRA versus inherited 401k. When a traditional IRA owner dies and his IRA is passed to a beneficiary, that beneficiary must maintain the account as an inherited IRA. The inherited account cannot then be converted to an inherited Roth IRA. An inherited IRA owner could take withdrawals from the inherited account and use that money to make an annual contribution to his or her own Roth IRA, assuming they're eligible under the rules. But no direct conversions are allowed. So an inherited IRA, you cannot convert to a Roth IRA. So here's the anomaly. While inherited traditional IRAs cannot be converted to an inherited Roth IRA, employer plan designated beneficiaries, living people, can convert inherited plan assets, like from a 401k, to an inherited Roth IRA. Go figure. Really interesting. How about Roth and after-tax dollars? No rollover from IRA to plan. Speaking of Roth IRAs and plans, Yep. Roth and after-tax non-Roth money cannot be rolled from an IRA to a work plan. So Roth and after-tax non-Roth money cannot be rolled from an IRA to a work plan like a 401k. Once these dollars hit an IRA, that is the end of the road. Only pre-tax monies can be moved from an IRA to a work plan, sometimes referred to as a reverse rollover. This is an exception to the pro rata rule and can be leveraged in cases when IRA owners are trying to separate their pre-tax IRA dollars from basis, that's after-tax dollars, in order to complete a clean, tax-free Roth IRA conversion. Why can't Roth IRA dollars be rolled over to a plan? Why do these anomalies exist? I have no idea, Andy writes. So I enjoyed that piece from Andy. I hope you did too. And that's all for the slot updates today. No questions. Good to see. Okay. All right, let's talk a bit about the markets. So the consumer price index came out last week, and inflation grew at a slower rate than expected, but was up from the previous month. So it came in at 3.2% year over year inflation, up from 3% in June. The analyst writing this wrote, not a lot of change in views from this report. The folks wanting, I'm kind of paraphrasing here, the folks wanting to limit interest rates hikes will point to the headline number as a signal inflation is getting under control and the Fed should be done with hikes, while the folks wanting to continue to increase interest rates, the hawks, will point to the still elevated core rate that appears to be stuck in the upper 4% range. The core rate of inflation, so this is referred to the core rate of inflation, also rose 0.2% month over month, but rose 4.7% year over year. And we talked about the differences in the reporting of the consumer price index in previous videos. It may make sense to have that discussion again. But we continue to believe labor has to weaken in order for the core number to drop meaningfully further. The producer price index at the wholesale level surprised to within a 0.8% gain year over year, up from 0.2% seen in June and above expectations. So again, core PPI rose 2.4% in line with last month, but again above expectations month over month. So this analyst writes, a slightly hot report, but nothing to be overly concerned about at this point. I think these are pointing, starting to point pretty well to stubborn interest rates, stubborn inflation, and I have a growing concern about a deeper and more volatile or aggressive recession. So today we see retail sales. Tomorrow is the FOMC, so the Fed minutes. So we'll learn more about what the Fed thinks, but we'll see if they're going to raise rates again. And they talked a bit about the market last week. So the market was modestly lower. The 10-year treasury bonds yields pushed up above the 4% mark. So that's a good sign. But really not much happening in the markets last week other than they were negative over, most of the markets were negative over the week because of the data we just talked about. All right, let's jump into our, like I said, there wasn't much from analysts this week. BlackRock, I like the BlackRock reports. They just said a lot of nothing. So I just want to remind you how how do you combat this uncertainty? And when is the recession going to hit? It's not, are we going to be in a recession or are we now in a recession? It's when it's going to happen and how deep is it going to be and how difficult. And how do you manage all this when analysts can't agree and the markets are kind of crazy all over the place? It is surprising, when you see, some of the data we've seen over the past week, the banks are getting hit over the past week, this week for sure. But last week, there were some downgrades of banks. There's a credit downgrades I'm talking about. There's a downgrade of the U.S. government, but the market kind of shook that off in that first week. Now, again, the markets were down last week and they're down again so far this week, but it's only 10:21. Who knows? Could have turned around already. But you've got to, I had a discussion with a client about a risk score, right? So there's different questionnaires that people use, that we use in our firm and other financial advisors use to determine the risk comfort of a client. And it's important to know, but it honestly should have little to do with your investment decisions. Your investment decisions should be driven by the plan. If your investment decisions are driven by the plan, your comfort level grows, your confidence level grows, and you should know where your funds are coming from to fund your plan, and if they're invested appropriately per the plan. Now, again, not to completely dismiss the evaluation of the risk, and that should be done every year or on a regular basis, just to kind of get a baseline and see where clients are. And investors are, but it shouldn't be the end all be all about, okay, this is how you should be invested because of this risk number. Again, that should be driven by the plan, and the plan should consist of those 3 pillars of investing that you've heard me talk about, and you can review the video, but you want to build that good foundation. And you've heard me talk about this as well. But when I was stationed in Northern California, I took a job in San Francisco when I first got out of the Air Force, and I was standing on the top of the Hilton Hotel where I worked in security at the time. And I was looking at the Transamerica building, and my supervisor at the time told me how these buildings were built on with different foundations to withstand, hopefully, earthquakes. And we were specifically talking about the Transamerica building. And I was told that the Transamerica building is kind of built on a big ball bearing. So it'll move and it might crack, but it shouldn't crumble completely. And that's how you want to build your investment strategy and, frankly, your financial plan. There's going to be times when the markets are very difficult and challenging, and there may be some cracks that we have to deal with, but it shouldn't just completely implode your plan and your retirement. All right. Well, you've got to be careful about that. So you have to have a well thought out, truly detailed and holistic plan. You have to have a good investment foundation. I think it should consist of asset allocation, principal protection, and account segmentation. And again, you can see what I mean in detail if you look at our 3 pillars video. And I'll ask, maybe we'll tag that video, the 3 pillars video, to this description and perhaps the card in the back. Okay, so we're going to switch now. I'm going to pull up my whiteboard. I'm going to get in position to talk about Social Security. So this is the last part of the weekly webinar, which we call our Financial 15. So it's about 15 minutes or so. This section is going to be part 4 of a 4-part series called Getting to Zero Tax in Retirement. And this is discussing Social Security, as you can see in front of you. If you're just joining us for this section, what you missed is about 25 minutes of market updates and some analyst reports and some updates from the Slott Group, which I think were really great today, as I really actually think they are every week when we read them. But that helps our viewers and our clients learn about pitfalls that they should be paying attention to when it comes to IRA distributions, and things that can't be undone, which is most important. It's not an uncommon occurrence that I talked about the class that we're going to be having and starting at the end of September. And it's not an uncommon occurrence where someone will attend the class and they'll learn all these great methods of becoming tax efficient. And they'll say, I got this, I can do this on my own. And they might meet with us and we'll sketch out a really brief kind of idea of how they should move forward. And they'll say, okay, I'm gonna set off on my own and do this. I don't think I need your help, and that's okay. That's fine. That's their choice. And a lot of people come back and they say, "Oh, I didn't see this landmine. I didn't see this pitfall. I wasn't accounting for this." I was just talking to an individual who had some really good intentions, but had a lot of incorrect facts. Folks, I watched a video yesterday of a financial advisor in northern New Jersey who was talking about fixed index annuities. And there were about 6 things that were absolutely wrong in that video. So this is really difficult and challenging stuff. And you have to specialize in these areas. You can't, I'm talking from a professional point of view. So I'm not gonna go into that too deeply, but just know that this information is out there for you on our channel now. And it will be available for some time. Again, the plan is to have a second website, Attleboro U, and that will be member-based or just for clients. But for right now, everything's available. So let's talk about Social Security. So Social Security can be taxed. Folks under 50, folks in their mid 50s, again, this isn't even on their radar thinking, what? Part of my Social Security can be subject to tax. What you're going to learn today is up to 85% of your Social Security can be subject to tax. Not taxed at 85%. People hear that 85% and they think, whoa, wait a minute, 85% of my Social Security is going to go back to the government. It might feel that way, but that's not how it works. I'm going to tell you how it works. So the amount taxed depends on this calculation called provisional income. People say, well, what's it based on? Is it based on taxable income? Is it based on modified adjusted gross income? Adjusted gross income? What's it based on? It's based on none of those things. It's based on a separate calculation the IRS has called provisional income. Provisional income is the income that the IRS tracks to determine how much of your Social Security is going to be taxed, period. And there are some separate calculations for that. So let's talk about what counts as provisional income. Well, any earned income you have counts as provisional income. So now, again, this is assuming that you're collecting Social Security and you're trying to determine how much of your Social Security is subject to tax. And I should have snapshotted on here, but there's a schedule that's in the 1040. I don't know the form number off the top of my head, but there's a schedule that helps you calculate how much of your Social Security is subject to provisional income. So any earned income, any pension income you receive counts as provisional income. Any rental income, if you have any rental properties at all, it's going to count towards provisional income. 1099s from the taxable bucket. Remember, folks, you've got your funds that sit in different buckets. Taxable, tax deferred, and tax advantaged or tax free. So we're talking about in the taxable bucket. I don't want to go back to the beginning here, but remember, these are typically your mutual funds. You might have some stocks in here. You might have some bonds in here, CDs, savings accounts, money markets, all of that, right? It can, of course, be in the tax deferred bucket, but the tax deferred buckets are IRAs, traditional IRAs. So traditional IRAs, 401ks, etc., retirement plans, things like that. Things that you're promised to pay tax for on later, you don't pay tax on it now. But back to the taxable bucket, these are things that you get taxed on every year. You get it 1099 that's issued from the federal government. You get it for interest, dividends, capital gains, long-term gains, short-term gains. And interest can be significant. Our money market account right now is pulling close to 5%. So that could be significant. Short-term bonds and, the government bonds are, I think the 90-day treasury is at about 5.28. I think that can be significant. So, it can produce some significant income if you have too much money in this taxable bucket. And we're going to talk about that. But that's what we're talking about the 1099s from the taxable bucket. Well, distributions from the traditional IRAs from the tax deferred bucket. So any distributions from traditional IRAs, whether they're required minimum distributions or just regular distributions you want to take. See, I'm blocking it a little bit with my face. Any distributions from the traditional IRAs and 401ks, etc. Anything that comes out of that tax deferred bucket is counted towards provisional income. This surprises many. I'll make this a little larger so you can see it. Interest from municipal bonds also counts as provisional income. But interest from tax-free, right? Tax-free, air quotes. You see me doing air quotes, municipal bonds. So they add that allegedly tax-free income in to that provisional income calculation. And then they add back in 1/2 of your Social Security, just to kind of put salt in the wound. So that all counts as provisional income. So what does that all mean? Follow me over here to the left. These are the current provisional income brackets. And these provisional income brackets haven't changed since I've been focused on tax efficient planning since at least 2012. If anybody knows that this has been updated since 2012, let me know. But as far as I have seen, or I can remember, they have not been updated. And so what that means is that your tax brackets, your marginal tax rates, capital gains rate, things like that. We see them increase every year with inflation numbers, just like your Social Security does. And, there's certain things that are indexed to inflation, which means there's a calculation and they go up every year. So if the income levels and your marginal tax rates go up every year, that means you're paying, more consistent or maybe less tax as your income rises, right? Because your income rate is adjusted up. The top of the 24% bracket right now, for instance, is about $364,000 for a married couple. Last year, I want to say it was about $320,000. So that's what I mean. Anything, you're able to capture more income in that tax bracket this year because of the increase in inflation. The problem with provisional income is that these numbers haven't moved. So let's focus on married filing joint. So if you're married filing joint and you have under $32,000 of provisional income, if all those things that I just talked about add up to, including one half of your Social Security, add up to under $32,000, well, you don't pay any tax on your Social Security. If from $32,000 to $44,000 in provisional income, you pay up to 50%. Remember, there's a schedule to figure out how much that is exactly, but you pay up to 50% of your Social Security is then subject to tax. Let me say that over again because it sounded a little confusing the way I said it the first time. Up to 50% of your Social Security benefit would then be subject to tax. And I'm going to show you the breakdown of that in a minute. Anything above, again, married filing joint, anything above $44,000 in provisional income, up to 85% of your Social Security benefit is then subject to tax. And of course, if you're a single filer, and we're going to talk about this as well, it's a little worse. So you got to be under $25,000 in provisional income to have none of your Social Security subject to tax. You got to anywhere between $25,000 and $34,000, up to 50% of your Social Security benefit is going to be subject to tax, and above $34,000, up to 85% of your Social Security benefit is going to be subject to tax. So what does that mean? It just simply means if let's keep it easy. Actually, let's use the numbers here. So you'll see here you got an income gap. So if your Social Security is at $55,000, that means you're about up to 85% of your Social Security is going to be subject to tax. So let's just assume that's the case. So $46,750. So you got to take 85%, $46,750. Let's make sure I'm not drawing on my, yeah, okay. We're going to make this a little smaller so I can see my own calculations and not block anything. Okay. So $46,750 flows into your tax calculation, just like you earned it. So let's just say it comes down to about here, this $46,750, and lands about here. And let's say that gives you an effective tax rate of about 20%. Now, why isn't it 22%? We've talked about this before, but I'll tell you again, your first several dollars. Well, I'll tell you what it is. If you give me a moment. Actually, we have the chart here. Woo. Join me. See how crazy this gets? Join me up here. This is the tax chart that you can get from our website. If you go to the slot corner, you can scroll down and get this. And let me just clean this up for us a little bit so we can see what we're talking about. Okay. So you can see here, we flip it upside down because it flows better for discussion. But from zero, the married couple, from $0 to $22,000, you pay 10% in tax. From $22,000 to $89,450, you pay 12% in tax. And then you from $89,451 to $190,750, you pay 22%. And it keeps going up like that. So it's not as though some people say, it's going to put me in another tax bracket. It doesn't include all your income. It's a gradual process. So let's swing back down to our section. I've kept this all together. You can see there's all four sections here. Roth accounts, taxable accounts, pensions, and now Social Security. So as I just explained to you, the income flows in, and now 46,750 flows into here. And in this example, it lands here. So it's the effective rate, the way I just explained it to you, is a 20% tax. So follow along back up here. I'm back up here on the right-hand side. So now if this 4,000 or 46,000 of that $55,000 Social Security benefit you may have is subject to tax, you multiply that by the 20% tax rate. That means $9,350 has to go right back to the federal government in the form of tax. So they give you $55,000 in Social Security benefits, but you got to send back $9,350. So you might say, okay, well, that's not too bad. I don't know anybody who really says that, but let's just say you do. And you say, okay, that's not too bad. I'm giving up $9,350. Well, the problem is that most people plan on using their Social Security benefit during retirement. Don't you? Yes, I hear you say yes. Yes, of course you plan on using your Social Security benefit during retirement. And you plan on using that $9,350. That's your money that you've planned on, and you might have worked with your financial planner. And I have to tell you, folks, I coach financial planners all around the country, and I hear from folks who work with other financial planners from all around the country, and they're not having this conversation about the amount of money they could potentially lose for their lifetime income, because Social Security is an annuity. It's a guaranteed lifetime income that's coming from the federal government. And suddenly you're planning on $55,000 and $9,350 is ripped out from under you. And it, of course, is worse than that, because most people have most of their money in traditional IRAs, traditional retirement plans and whatnot. And when they're planning on using that $9,350, where do they take that income gap from, that shortfall? This is what we call the income gap. So now there's a big gap in their income. I think $9,350 a year is a pretty big income gap. You can take a nice vacation. You can do whatever you want with that, except now you got to give it back to the federal government. So what do? You take that money out of your IRA because that's where most of your money is, right? But it's not that easy, is it? Because you've got to take more than the $9,350 out of your IRA to actually get $9,350, because you have to pay tax on that money. So the math says at a 20% tax rate, you actually have to take $11,687.50 to net out a spendable. So let's not, we don't have to use fancy words like net out, things like that, but a spendable $9,350 will cost you $11,687.50. And then, of course, it doesn't stop there, because as I told you, Social Security increases with inflation every year. Sometimes it's small, sometimes it's super big, like it was last year. So every year your Social Security goes up, your tax, the provisional income doesn't change. I just told you, I haven't seen a change in this since 2012. So the provisional income, the tax amount on your Social Security gets greater, or you trigger different brackets, or God forbid, one of you passes away and now you're a single filer instead of married filing, jointly file, and more of your Social Security is subject to tax. And the tax rate is higher. So you have to take more and more money out of your IRA. And of course, then you have opportunity cost. The more money you take out of your IRA, the less it stays in there and is able to grow. And that's where this really gets big, this compound number. So a simple $9,350 distribution to cover tax or less amount in your coming to you in Social Security can mean hundreds of thousands of dollars, literally hundreds of thousands of dollars over your lifetime that it's costing you because of that. So what's the answer? How do you manage this? Well, you got to ask yourself first, what is not counted as provisional income? Remember all these things we talked about here: earned income, pensions, right? Earned income, pensions, rental income, 1099s from the taxable bucket, distributions from traditional IRAs and 401ks, etc. Interest from municipal bonds, and one half of your Social Security. Well, for crying out loud, what is not counted as provisional income? Well, I didn't say Roth, right? I didn't say Roth. I didn't say Roth because qualified distributions coming out of your Roth IRA are not counted as provisional income. Distributions from a Roth 401k are not counted as provisional income. So you figure out the amount that you should have in your taxable bucket, that mathematically ideal amount. You figure out the mathematically ideal amount you have in your tax deferred bucket, and you can contribute or convert money into the Roth IRA. We learned about Roth IRAs, Roth 401ks, Roth retirement plans in the first part of this. If you haven't watched it, go back and watch it, because we talk about the overall goal. The overall goal, of course, is to get to net zero, right? That sounds like greenhouse emissions kind of thing. We want to get to zero tax in retirement, or as close as possible. The way you do that is that you identify how much you have in each bucket, or how much you should have in each bucket, and you push the rest into things that aren't going to cause you future tax pain. Yes, you have to pay tax now, but if you believe the taxes are going to be even a little higher, we know they have to be significantly higher, but if you believe they even have to be a little bit higher in the future, it can make sense to shift those monies over to this side of the ledger, right? Get those things over to tax advantage and tax free. Just the right amount of money here. Maybe you got some money over here and you want the rest of it to live here, so that anything that comes out of there is zero tax. Well, the first thing, I know I'm going back and forth. This is kind of fun for me, but so what's not counted as Roth or provisional income? I didn't say Roth, and I also didn't say properly structured cash value life insurance, or as my friend David McKnight calls it, a life insurance retirement plan. Properly structured distributions from life insurance policies do not count as provisional income, so they can help minimize or eliminate your taxation on Social Security. So again, you want to that's the two things that are truly tax-free are Roth or cash value life insurance, or also known as life insurance retirement plans. So you determine how much you need to have in each one of these buckets, and that's how you come to a tax balanced approach. I kind of like that phrase. So some people say, and I talked about married filing joint versus single, just like your tax code, folks. As soon as one of you passes away, as soon as one of you is in the ground or whatever, on the mantle, in the ground, then your spouse has more aggressive tax rates, regular tax rates, more aggressive provisional income rates. They probably inherit your IRAs and your other accounts, so they inherit a bigger tax driver. All these funds that are driving all this tax, they inherit these things, and they're going to have to pay much higher rates just by the fact that one of you passes before the other, which is very, very likely, as you know, as you enter retirement. I think it's after you're in your mid-40s, the chances of you and your spouse dying at the same time dramatically drop. So when you're younger, it's much more common. But as you get older, of course, one of you is likely to go before the other. So people say, okay, listen, I've got a pension. I've got a $50,000 a year pension. That's automatically going to make my Social Security taxed into perpetuity, as you say, right? At 85%, up to 85%. It would be 85% probably at that point. So what do you do? And is that what Walter's asking? So Dr. Paul. Hi, Dr. Paul. I see a question. Since the 50%, 85% income thresholds are inflation unindexed, I am already at the point that my Social Security income is subject to taxation, even if I had no other income, headed towards 85% regardless, Walter says. What a great segue. Thank you, sir. Yeah, what do you do? What do you do if your Social Security is going to be taxed anyway? Well, you darn well better protect the rest of it. If you can't control the fact that your pension is going to be taxed into perpetuity, or your Social Security is going to be taxed into perpetuity, maybe both things, well, then, your mathematically ideal amount in your tax deferred bucket isn't going to be the $2 signs. It's going to be zero. You're going to have to get all that money over to Roth or to cash value life insurance or life insurance retirement plan, whatever you can do to get to tax free or tax advantage. The only two things, I'll say it again, that are truly tax free are Roth, cash value life insurance, also known as life insurance retirement plan. So you may be able to keep a small amount of money over here. What do we want? We want 6 months So 1 year of expenses, typically 1 year of expenses, typically. Anything more than that generates 1099s, interest, dividends, capital gains, all those things that generate more tax. All these things equal tax, and all these things take it out of your control. Right now you have control. You can make these changes and move forward. So if your Social Security is going to be taxed anyway, you better darn well move everything else over to, whoops, what happened to that? You better darn well move everything back to this side of the ledger that you can, because this is where your protection lies. Anything that comes out of here, as we know, you don't pay tax anymore on that. Yes, you got to pay tax to get there. And if you're meeting the requirements, there's a 5-year rule, all those different things. And the life insurance has to be properly structured. But if you're meeting those requirements, then you won't pay any tax on those distributions. And by the way, your heirs won't pay tax on those distributions. So I love one of the, I've heard Ed say it a million times, but he says, move things from forever taxed to never taxed. I like to say never taxed again, forever taxed and never taxed again. But he said something, and again, I've heard it, but it just clicked when he was here live for us. He said, what you're really doing is you're locking in your tax rate for life plus 10 years. So you're literally choosing the tax rate you agree to pay, and you make that choice. I'm agreeing to pay 24%, not more than that, for the rest of my life plus 10 years. So that's the kind of planning you want to do. And going back to what Sarah said earlier, it may not make sense to take delay your required minimum distributions. If you can get those inherited IRA monies out that you can't convert. She was talking about inherited IRAs. And again, there's one instance, and I can't remember the birth year, but there's the people that turned from 72 to 73. 73 is the new age for required minimum distributions until it turns to 75. But that's several years away. But those people that went from 72 to 73, they were also allowed not to do RMDs. But everybody else, mostly everybody else, has to do RMDs except for those folks in those few restricted sections, allowances. But it may make sense for you to take that required minimum distribution, because if you can get that required minimum distribution out at a 20% tax instead of a 40% tax, which would you rather pay? Of course, you'd rather pay 20. I use the analogy. Back in the pandemic, I filled up my F-150 gas thirsty truck for $1.85 a gallon. If I could have bought all the gas I'd ever need for the rest of my life at $1.85 a gallon, I would have done it. Our goal is, we talk about inverted yield curves, things like that. So most people come to us, and in their plan, they show that we have these tax reports. So in their plan, the tax report looks something like this. So in the early years of retirement, you might have lower taxes for a short period of time, and then it just goes up exponentially. It actually looks more like this, right? We treat it differently. We like to do this: fill it up, and then ideally drop it down to zero. We have this cliff. So you want to turn that upside down. Choose the tax rate that you want to pay, what makes sense for you today. Push everything else over to the tax efficient ledger side of the ledger. And that's, folks, how you get to zero tax, or however close you can get for you. So that's a lot of information. I just like to zoom in to see where we started and where we are. You can go back and look at all 4 of these videos. This was a 4-part series, and we started, I don't know what day we started, but it was 4 weeks ago. But we started with how to get to zero tax. We started with Roth IRAs, and we talked about Roth. We showed the benefit to this for John and Sally here, the benefit to them to being tax efficient. You might remember at age 85 was about $2.5 million. So all this work of paying tax now, choosing your tax rate, what's better for you, it was a benefit to them of spendable money. Let's again talk about spendable money of $2.5 million more just by being tax efficient, not taking additional risk, not spending less, none of that, just by being tax efficient. So we looked at the why and the goal, and then we looked at Roth, as I said. Then we looked at where's my taxable account. We kind of jumped around a little bit. Taxable accounts. We were down here. We talked about those taxable accounts. There's 1099s that come out of those taxable accounts. The mutual funds that you just can't control. You can get capital gains when you've got a down year. That really stinks. And we talked about pensions. We talked about pensions. And, again, the answer to the too much in your taxable account is you figure out you can pay tax out of it. You can pay your expenses out of it. You just want to draw that down to an amount that's about 6 months to 1 year of expenses. Push everything else over to the tax-free side of the ledger. You can use cash value life insurance or life insurance retirement plan. If you have a pension, all is not lost. You may have a lump sum option. So if you have a lump sum option, it may make sense for you to take that lump sum option and roll it over to an IRA that is not a taxable event. As long as you do it right, and it's really hard to do it wrong, you roll it over to an IRA, then you have a plan for converting those IRA dollars to Roth IRA dollars. And anything that comes out of a Roth, as long as you meet the guidelines, are zero tax for you and zero tax for your heirs. So that was part 3, pensions. And then this last part we just went over today was Social Security. We talked a lot about Social Security. You can get to the 0% or 0% of your Social Security subject to tax. It's not for everybody, but when it works, it's beautiful. And when it works, if we are now getting zero, we're not paying tax on our IRA distributions. And we talked about how that works. We can take distributions from those IRAs that are below your standard deduction, and you can write off that entire deduction. You don't pay tax. It would still apply to provisional income. So you've got it. That's the art to it, folks. Any distributions from your Roth IRA are not subject to tax. Any distributions to a properly structured life insurance retirement plan, not subject to tax. And for your Social Security, if you're below the thresholds we talked about, also not subject to tax. And folks, that's how you get to zero. Again, if you can't get to zero, you want to get everything you can over to that side of the ledger, because the pensions and the Social Security tax is going to increase, and it's going to have a great effect. All right. That is it for today. That was a lot. It's great to see you all. It's almost the end of our hour. I look forward to seeing you next week. I do have the topic for next week, but I can't remember what it is. So you're going to have to wait until you get the notice via YouTube. If you love this video, share it. Give me good comments. I'm going to say hit the like, subscribe, and notification button. If you need to have questions, or you want to schedule time with me, you can reach us at questions@outofborwealth.com. It's questions@outofborwealth.com. If you want to go through and look at our awesome new website with a lot of information, you can go to outofborwealth.com. There's, we have tons of videos on there and good information. I think there's 160 some videos that we've been doing throughout the years, and that's available to you. But I'd love to hear some feedback. Send me your feedback on the website, videos, whatever works, things you'd want to hear about. That's always helpful too. I keep a running list. I probably have for the next several months for because as I'm talking to people or receiving emails, things like that, that always helps me figure out what I'm going to talk to you folks about and give me time to prepare. And that's always a lot of fun. So thanks for spending time with me. We'll see you next week. Have a great week. Take care.